Hey, what's up, everybody? Welcome back to episode 2. We are talking about the creation and the maintaining of wealthy financial habits. If you missed episode 1, I encourage you to go back and check that out, give it a listen. We talked about the importance of putting money aside in your savings account so that you are prepared for emergency or disaster. Now, today, what I want to talk to you about briefly is something called your debt to income ratio. That's right, we're talking about the nasty D word, the big D word, debt. Okay, debt is bad. If you didn't know that, debt is bad. We want to try to avoid debt. There are some good reasons to go into debt, or I should say some acceptable reasons to go into debt. Okay, I don't know a lot of people that can save up and pay cash for their first house. Many of us can't save up, have a hard time saving up to pay cash for a car. Okay, so taking out a mortgage, a car loan, I think those are acceptable forms of debt as long as both of those are reasonable and within your budget. I think we all have seen people that don't make a lot of money, but they're driving a car that costs them $1,000 a month. That's just not reasonable. That's not smart. Now, when you go to your bank or your credit union and you are looking to take out a new mortgage or get that car loan, this is actually an equation that the banks and credit unions rely heavily on when deciding to give you a loan or not. So it's part of their underwriting requirements, in addition to making sure you have good credit, in addition to analyzing the collateral, making sure you're not borrowing too much in relation to what the asset is worth. Okay, that's called the loan to value ratio. If I'm buying a house for $250,000, I can't go to the bank and ask for a loan for $400,000. Right? So your credit, your loan to value, then what they're also going to look at is that debt to income ratio. So the debt to income ratio is quite simple. Essentially, you're going to take your total monthly debts per month, so the minimum payment of your monthly debt payments, add all those up and divide those by your total monthly gross income. So not your net income, your gross income before taxes and everything are taken out. You take that and divide it, and you're going to come up with a percentage. All right, so let me show you how to calculate that. I'm going to jump out to an Excel spreadsheet here, and let's show you how we quickly would calculate a debt to income ratio. Okay, so I like spreadsheets, so you can pull up a spreadsheet and do this. You could also just pull out your paper and pen and a calculator and do it that way. I'll make a spreadsheet and save it, and this isn't something that's going to change a whole lot. I'll go in maybe a couple times a year and just update these numbers, and again, just to know where I'm at, just to keep an eye on this. First thing, you're going to list your total monthly debts. So let's say you've got a mortgage with $1,400 a month payment. You've got one car loan that's $200. You've got a second car that's $300 a month. You got two credit cards. Your Amex, you pay $150 a month on that, and your Visa, you pay $50 a month. And you still got that student loan that's out there. You're paying $150 on that. So you're going to add up your debts. Get your total there. Come over to your income. Again, this is your monthly gross income. So, for example, let's say you make $6,000 a month gross. The salary is $72,000 a year. So you get that. Then you're going to come down here to calculate it. Very simple. You're just going to take your total monthly income divided by, your total monthly debts divided by your income, and I get a percentage. Move your decimal 2 places. 37.5% is the debt to income ratio with this particular example. Now, what's a good debt to income ratio? What's a bad debt to income ratio? Typically, the banks and credit unions are going to have their ceiling on a debt to income ratio of about 45%, 40 to 45%. So if you come in above that, you've got a little bit too much debt. If you're above 50%, you need to focus on that. You need to work on that. A good debt to income ratio, I would say, is 25% or lower. So congratulations. If you calculate that and you're at 25% or lower, you're doing well. That means you've got a lot of room in your income to make sure you're doing other things with your money to help you build wealth, like saving for retirement and investing, putting money away for your kids' college, these things we talk about, right? So know your debt to income ratio. If you're too high, come up with a plan on how to improve that. So how do you improve your debt to income ratio? Well, think about it. You either increase your income, so the bottom half of the equation, you either bump that up or you lower your debts. Focus on paying your debts off. And we're going to have an episode devoted entirely to paying off debt and some strategies to accelerate the paying off of your debt. But for now, I just wanted to cover that debt to income ratio. I believe it's key. You've got to know where you're at, and you've got to set some goals there and work towards getting a debt to income ratio that's in line. Hope this was helpful. Let me know what questions you have. Thanks. See y'all next time.